Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Gene Munster, Managing Partner at Deepwater Asset Management. We're talking about the outlook for Magnificent Seven stocks and emerging technology stocks and the LOUP ETF that Gene manages. Gene, welcome back. Great to have you with us today.
Fun times.
Yes, yeah, right. So let's start with Monday's market sell-off. And we know that a number of factors are being blamed for the rout, including big tech's recent quarterly earnings that failed to wow investors. So if we look at the stock price reactions post-earnings, it seems that investors loved Meta's results and they liked how Meta's AI investments seem to be paying off. They were okay with Apple's quarterly results, slightly disappointed with Alphabet's and Microsoft's, and they hated Tesla's results, also Amazon's results. But I was interested in your thoughts on these quarterly earnings. Who impressed you the most and whose results you did not like?
I would say the most impressive was Meta. The stock reaction, I think, was appropriate for that. And the reason is that it was the first time that Zuckerberg gave a compelling view of how AI is going to impact their business over the next 6 months, 12 months, and 5 years. And he broke it down into talking about core AI and generative AI. And so core AI is kind of them weaving AI into the fabric of their products. And generative AI, he talked about new initiatives, Meta AI, for example, what they're doing with Llama. These are new businesses that currently don't generate any revenue. And in the midst of all that, they had their core business is doing well. They guided for the September quarter. If you take the high end of their range, which typically they hit the high end of their range, revenue will be up about 20% year over year. And going into the print, expectations were for revenue to be up 15%. So they guided essentially higher than the street for the September quarter, which was positive. So I think that does kind of stand alone. And then separately, I think Google and I think Meta and Google are the two best positioned mega caps when it comes to AI. Google, their core search business up 14%, similar growth rate as what we saw in the March quarter. The disappointment, of course, was YouTube. It grew, call it low teens, and expectations were to be low 20 growth. But that is more sensitive to the macro. And I think that what ultimately Google continues to do is show that their resilience of their search business is a safe haven. And so those would be the two that I would point out. One last one that stuck out is related to Apple. And Apple, their guidance for the September quarter calls for 5% revenue growth. The street was at 5%. That's the same growth that they grew in the June quarter. So call it maintaining their same top line growth from June to September. And that number really is impressive, that 5% growth in September, because this Osborne effect is going to be increasingly impacting Apple's results in the September quarter. And this is the effect of consumers holding off on buying purchases in anticipation of something new that's coming out. And in the case of Apple, of course, I think that the anticipation around what's going to happen with next generation with these AI-powered phones, I think is going to get consumers excited about that, but that anticipation has a negative impact on the near term. So the fact that they maintain top-line guidance in the face of the Osborne effect, I think, was testimony to how strong their base is. So those are the three that jumped out.
Awesome. So all these companies, particularly Microsoft, Alphabet, Amazon, and Meta, they revealed massive increases in AI-related spending. and spending in general. So they spent over $100 billion in the first 2 quarters of 2024. And investors have become a little more demanding now. They are very closely watching whether earnings growth justifies the huge capital spending on AI. So do you think that AI is still in early innings and it is too early to expect payoffs from these investments?
The simple answer is I think we're still early. I continue to believe we are in the early stages of a 3 to 5 year bull market. So call it in year one of a 3 to 5 year bull market that will end in a bubble, the bursting of a bubble. I think that an uncomfortable view of this is that I think that this run that we're going to have over the next 3 to 5 years will be a bigger run than we saw in the NASDAQ from 94 to 2000. And the reason why I say that that's uncomfortable is because it seems disconnected with logic. That was such a magical time, 94 to 99, around just kind of the eye-opening of how the internet can continue to sustain a market. So understand that is a bold prediction. But so I just kind of start there is that I continue to firmly believe that AI will be bigger than the internet. And then it kind of comes back to, well, then I think a natural question, which is you're asking is, well, what about what's going on in the near term that kind of justifies that view? And you talked about CapEx and infrastructure spend, and it has become the hot topic. And I think that I just have a different view in terms of how many view the spending. My view is that increase in spending is a good thing. It's a good thing that these mega cap companies are making the investment in infrastructure and CapEx. And the reason is that they are uniquely positioned to lay the groundwork for this AI revolution that I think we're going to have over the next 3+ years. And specifically is that they're the only companies that are really building these large language models and the infrastructure around it to power that. So the more spending that happens in CapEx, the better it is for AI. And specifically to add some numbers to the more, in quotes, spending, is that going into the June quarter, most investors were thinking that CapEx amongst the Mag 7 was going to be up about 35% year over year. And exiting the quarter after the commentary from the companies, it's going to be about up around 45%. So we see this acceleration. Many investors read that increase in CapEx spending as a negative because they don't know what that means for margins over the near term, the next 1 to 2 years, and they're just not seeing the payback and understanding how when you're spending tens of billions of dollars, how that's going to yield a positive outcome. I view it differently. I think that the more that they spend, the better they are positioned for the next 3, 10, 20 years related to AI. And separate is to put some context in terms of the magnitude of how much they're spending. You mentioned that $100 billion in spending. And so kind of think of this as each company spending, there's 30, 40, 50 billion a year. These are $1.5 to $3 trillion companies, and that are typically generating about $100 billion a year in profits. Now that all that CapEx is not going to AI, only call it half of it is going to AI. And so what we're really talking about is 15 to 25 billion in additional spending per year to essentially grow a $3 to $1 trillion market cap company. So I think that ultimately this is a wise investment for these companies to make, and I applaud any increases in CapEx.
Awesome. So 3 to 5 year bull market in technology. You heard it from the tech guru. So I agree with you that AI revolution could be much bigger than the internet. So Gene, you mentioned the resilience of Google's search business. So I wanted to talk about the recent antitrust ruling against Google. And it was a big news because it impacts two technology giants, Google as well as Apple. So could you please explain to our listeners what this ruling means for Google and Apple?
So for just laying the groundwork here is that the Department of Justice has had a case that's been being adjudicated through the District of Columbia District Court for the past year plus. And that is related specifically to Google paying for placement of their search engine. So it makes it easier for people to use it. It comes as like a default on iOS, for example. Safari is a default on there. So Google pays about $50 billion out per year. It's called TAC. It's been growing at about 6%. So this has been kind of part of their business. And they think of this as well spent in insurance policy. They spend, it increases at 6% a year. Their search business grows at 10 to 15% a year. It's a way to protect their search business and kind of grow it. So that's what's was kind of at stake. And this Judge Mehta ruled that they were, in fact, in violation. And so Google's going to appeal that. So that's kind of just the setup. And so what's at stake here for Google? The simple takeaway is I think this is actually a good thing for Google. I think that if they do, it is ruled that they cannot spend that kind of money to get placement of search. I believe that they will win that search back, that consumers are habitual about Google. The brand is so strong. None of the alternatives are 10x better. And so given what is likely one of the remedies is a choice screen, well, when you're setting up your phone, for example, you'll get a list of 5 different search providers, and then you pick that one. I think that there's a high probability that Google will maintain that. So there's a lot of work that we could get into around that justifies that, but I could just leave it at that I think that this is ironically a good thing for Google. It's a head scratcher to me that they're appealing this, because I think this would be a good thing for their business. But the second piece you talked about, Apple, this one's more complicated. About 15%, I estimate, of Apple's operating income comes from Google paying Apple to have Google be the default search within Safari. And so that's a nice piece of business, probably an understatement. And the dynamic about what the remedy is, whether it's a financial remedy that Google pays or it's a procedural remedy that impacts how the relationship between Google and Apple work, that's an unknown. My sense is that ultimately, just play this forward, I think that this is going to get overturned. And the reason why, and so I think that it's topical today. It makes sense to kind of go through the gives and takes on it. It's potentially more negative for Apple, but I think it gets overturned. And the reason is that the DC District Court tends to be aligned with the Department of Justice. Not only geographically is it close, but kind of from an ideology standpoint, they're close. And so it makes sense that the Department of Justice went to this court initially. And as you appeal it, there's 3 courts higher that you can appeal to. And as you go up the appealant process, you're going to likely come into a court that is more favorable, more business friendly. And if you just looking at the data, is that there are instances where this court has been appealed up to the Supreme Court, and 62% of the time, the Supreme Court has overturned a ruling from the DC court. Now, typically overturn rates are much lower, call it sub 25%, but it's much higher. So I think at the end of the day, this is going to be a bunch of noise. It's going to take 1 to 3 years to resolve itself, but it definitely makes for some good arithmetic in the near term to try to kind of understand the near-term impacts.
Awesome explanation. So continuing our discussion on Apple, I know that you have been bullish on Apple for a long time, and the company was seen as a latecomer to the AI race earlier, but recently they have announced several AI features. So do you think Apple Intelligence will lead to a strong iPhone upgrade cycle?
Absolutely do. I think this is going to be the strongest upgrade cycle. You want it to be strong. You want each cycle to be better than the cycle before. But I think this is going to be a step function up. And typical cycle lasts 1 year, maybe a year and a half. I think this is a 2 to potentially a 3-year cycle. And the reason is that I think that these Apple Intelligence features, and there will be many of them that will be just kind of embedded through the hardware and software, call it 30, 40 features eventually. I think that those are going to be some of these features that people are just going to love and won't want to live without. And ultimately, to get those features, you got to upgrade your phone. If you do have an iPhone 15, of course, or an M series iPad or Mac that does work on it, but call it 80 or so % of the devices that are out there aren't going to be able to run these. And so it creates a real catalyst. And this kind of comes back to one of the central topics around AI, which is, when are we going to see the substance? I think in the case of Apple Intelligence, they talked about rolling out these features over the next year. And some of them can be subtle, like something as simple as being able to find what you're looking for on your phone, where it searches all of your documents on your phone or your computer, your text messages, it can summarize them, to photo editing, to more advanced things like being able to do agentic AI, where they can actually do tasks for you. You could ask your phone to schedule an Uber, for example, for you at a certain time in the future. So I think that these features are going to be exciting. I think it's going to be, you're going to see just a tsunami of upgrades. And ultimately what it comes down to, when I think about the numbers, is that for this year, I was mentioning that Apple's growth is 5%, expected growth in the September quarter. The street's looking for next year, the overall revenue growth to be around 7%. I think it's going to be closer to 9%. So it may seem small, 7 versus 9, but in the context of Apple, that's a big delta. So I think we're going to see a better number there. And then in 2026, the street's looking for, call it 6% growth. And I suspect it's going to be closer to 8. So I think we got a couple years where the numbers can move higher as these AI features motivate people to upgrade more soon.
Very exciting for sure. Now let's talk about the most important stock for the market, Nvidia. And Nvidia so far has emerged as the biggest winner of the big tech's AI race. And however, the stock has been quite volatile over the past couple of weeks or so. And one of the reasons is that these reports that their AI chip Blackwell is going to be delayed. And Nvidia reports at the end of this month. Do you think investors should be concerned about these reported delays?
The simple answer is it doesn't change the big picture of NVIDIA's opportunity. And so a 3-month delay and to 3, 5, 10-year kind of shift from the internet and mobile to AI, I think that this is relatively small. So I think that the simple takeaway is this is a product timing question. I think it's relatively small. I think that the question that most investors are trying to wrap their head around is, what does all this mean for their growth rate in calendar 25 and calendar 26? And the kind of the loose numbers are that the business more recently in the April quarter grew at about 270%. Huge growth. And those growth rates aren't sustainable. And so that everyone knows they're coming down. And I think for next year, the street's looking for about 38% growth. This is for calendar 25. And for calendar 26, that number drops to 15%. And so you have this just breathtaking acceleration in business, something that I've never seen, going from a $20 billion plus business to a $120 billion plus business over the course of a few years. I mean, it's remarkable. And so that growth naturally is going to start to taper off. And I think that the timing of a chip is just less relevant to the kind of central question is, what's NVIDIA's growth rate going to be next year and what's it going to be in 2026?
Now, moving from the hottest of the Mag 7 to the worst performing stock of the Mag 7, Tesla. So Tesla was supposed to show off its robo-taxis this week, but they have postponed that event and they have postponed to October 10th, 10/10. So what can investors expect on October 10th? Should they expect a robo-taxi without traditional controls like pedals and a steering wheel? And I was also interested in your thoughts on a recent report in the journal where they looked at over 1,000 Tesla crashes and were able to piece together 222 incidents. And they concluded that Tesla's autopilot sometimes fails to recognize obstacles on the road, and that results in crashes. So do you think Tesla will be able to solve autonomy with its vision-only approach?
I'll start with the vision question and the reporting from the journal, which was amazing reporting. I was impressed at the level of detail that they went through. Yeah. And that was not a good read on kind of what's going on with autopilot. I appreciate that distinction you made between autopilot and FSD. They are two different features, and ultimately, there are some horrible things that happen with autopilot, and there are a lot more horrible things that happen when humans drive. So I think that there is, I think a central question is, I feel for all the families that are impacted by these, there are a lot of families that get impacted. Almost 40,000 people lose their lives every year in the U.S. in car wrecks. I just can't, that number is just a haunting number. So I think that the issue here is that autopilot should not exist. It should just be FSD. And so I think that's one piece to it, is that ultimately autopilot is kind of a pseudo step towards full self-driving. And separately is, do they need to make a change to either autopilot or the tech stack for FSD to enable these, to make sure these horrible things that the journal is reporting don't happen? And the answer is, I believe that they have to do that. I think that adding some other layer of tech, and of course LiDAR is the one that gets talked a lot about, is necessary. Now, Elon has turned this into a holy war against LiDAR and saying that we can do it all with vision. Don't try to complicate things by adding LiDAR. And I think there's a lot of misunderstanding about what adding LiDAR senses to the stack, what it means for how reliable it is. So there's a view that if you introduce LiDAR into this tech stack, then all of a sudden the computer vision, the cameras don't work as well. And I think that that's noise around the topic. The reality is this, is that humans are bad drivers. Let me take that back. Humans are great drivers when they're not distracted, but they're most of the time distracted. So they're bad drivers. And I think that adding another layer of sensors as a reinforcing layer, I think would be helpful at improving the safety of these systems. And I think ultimately they're going to have to do that. And by the way, I'm a huge believer in where Tesla's going. I don't want my comments to be misunderstood. I think they have to add this. And I think they're going to be one of the first companies to really crack this code around autonomy. And I think it's going to be a value creation for investors.
Okay, great. So a short question before we move on to emerging technology stocks. What are your 3 favorite mega cap tech stocks now for the rest of 2024 and beyond?
Well, we in our kind of our flagship Titan fund, we own Meta and Google, those two, and then personally, I own Apple and Tesla. I give 4, and so I think those are 4 well-positioned companies for way AI plays out over the next 3 to 5 years.
Okay, now let's talk about emerging technology companies. And you run this ETF, the Innovator Deepwater Frontier Tech ETF. The ticker symbol is LOUP. And this invests in companies that are leading the next wave of innovation. And these are relatively smaller companies, not as big as the mega cap giants. So we know that many investors are now looking beyond the Mag 7 trade. And particularly they expect that once the Fed starts cutting rates, then smaller companies are likely to benefit. And also the AI trade may start to broaden out in the coming months. So please tell us about this ETF and how it could benefit from lower rates.
So the The goal of the ETF is to find opportunities outside of megacap. I think it's important that investors have some exposure to megacap for all the things that we've talked about earlier. But there's also this opportunity for emerging tech. And these are companies that are smaller, tend to be below $100 billion in market cap. But that's really what we're looking for is frontier tech. And we define that as companies that are going to change how we live in the next 5 years, frontier tech companies. And so, as you mentioned, is that many of these companies you probably haven't heard of, but it's a portfolio of 30 companies that about 60% of them have some form of AI exposure. Many of those are hardware-related companies because we think that's the initial phase of the next couple of years. We think the hardware is the best way to be positioned. So that's what we're doing. We're finding these frontier tech companies that are going to change how we're going to live in the next 5 years.
Great. Could you talk about some of the top holdings that you like a lot? I see a lot of companies that our investors, our listeners may be familiar with, and some of them our listeners may not be familiar with.
So there's companies like ASML. ASML makes the machines that essentially, this is a company based out of the Netherlands. They make the machine that makes the chips, the most advanced chips that, for example, TSM, Taiwan Semi, uses to make Nvidia chips and Apple's chips. And so ASML is a company that it's not very glamorous. Their business is really lumpy. And so I think that is one reason why some investors don't purchase the stock is because they're selling these systems that are incredibly expensive. And so you have a few orders move from one quarter to the other. It adds some lumpiness to it. But we feel really good about the trajectory and just how difficult it is to make the machine that makes the machine that makes the chips. Another example is Micron. So they're a high bandwidth memory. What we're seeing is that in the GPU side, this, of course, is Nvidia. They're starting to fuse memory alongside the GPU to create more processing power. And so Micron's another example of a company that is benefiting that. And then companies like Take-Two, this is outside of the AI, but Take-Two has an opportunity to, their next version of Grand Theft Auto is just an exciting area. It's probably the biggest video game upgrade cycle I'm going to say in the history of video games, it's been, call it 10 years, 15 years since they last upgraded. They've had smaller upgrades as they've gone along, but this is the first full upgrade. So we'll have that in the next year. And I think that's going to be an exciting opportunity for the company.
Awesome, Gene. We'll have to leave it there, but thank you so much for joining us today and for sharing your insights.
Thank you. Talk to you soon.
That was Gene Munster of Deepwater Asset Management. Let's quickly recap some of the tickers that we talked about. So Gene's ETF is LOUP, L-O-U-P, and he talked about some of the top holdings. ASML is ASML, Micron, MU, and Take-Two Interactive is TTWO. Now, for mega-cap technology stocks, you all are familiar with the tickers, so I don't need to repeat them. But if you're looking at ETFs to invest in mega-cap technology stocks, there are several options available, some very popular ETFs. The one which is my favorite is QQQM, which is the cheaper version of the ultra-popular QQQ ETF, the Nasdaq 100 ETF. And you get exposure to all mega-cap technology giants in one ETF. And QQQM charges 15 basis points, so it is suitable for longer-term investing, whereas QQQ charges 20 basis points, but it is huge and has massive liquidity, so that is more suitable for traders. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcasts. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.